It's a pleasure to be here. I think the people introducing the session this morning mentioned the joy of being in Montreal, which I can tell you is a particular joy when you've come all the way from Sydney and you step off the plane into Montreal. It's great to be here. This is work studying again, following the theme of the past two papers, 401k plans and their choice architecture. It's work that I've done with Julie Agnew from the College of William and Mary, Angela Hung from RAND, and Nicole Montgomery, who's in the marketing department at UVA. And this work, we're very grateful, was sponsored by the TIAA Institute, but doesn't represent their views or those of RAND. What I'm going to talk about this afternoon is a labelling question. So what do we call the options that people can choose from on a 401k plan investment menu? And one of the things that we're studying here is the introduction of what's been called white label funds. So a white label, the way that you would think of it for a grocery or a supermarket, a particular item that is generic and not branded to a specific investment company. Now these are becoming increasingly popular and important in 401k plans, so that now, according to Hewitt in 2014, about 25% of investment options were white label investment options and about 75% were non-white label, what we're going to describe in this study as branded investment options. So why or why not might a 401k plan sponsor decide to include these generically labelled funds on the investment menu in their choice architecture rather than a branded fund? Well, there are costs and benefits associated with this, as you might think, and that's why we've got a proportion of white label options in menus and a proportion of branded options in menus still. In terms of advantages, it gives the plan sponsor primarily flexibility over which investment funds are going into any given option. So they can choose the construction underlying a particular white label investment option for themselves. The disadvantage associated with that is, of course, that if you construct the option yourself, you have to take responsibility for it. So that means that you have to report to your participants, your plan participants, about the content of those white label options. You've got to meet certain compliance obligations. You've got to constantly monitor what is underlying these white label options and how they're going. You've got to bring all of that investment management in-house, take responsibility for it and communicate it effectively to your plan participants. But at the same time, and as the last couple of papers that we've seen has really highlighted, choosing what's on a menu is very important and influential and can have serious impacts on the long-term benefits of the employees who are participants of these funds. So choosing a white label approach allows you probably to replace the underlying funds more easily if they're underperforming without a lot of advance notice and transactions costs or switching costs associated with your menu. And you can simplify the menu more easily and change it by changing the content of these white label funds. So even though the compliance costs are higher, and the in-house servicing of these particular options can be taxing, there are some advantages in terms of flexibility and control that could be very appealing to a plan sponsor. They can be included also in a menu with branded funds, or they can be the only options offered in the retirement plan. And we've seen several tables like this already this afternoon. This one is from the New York State Deferred Compensation Plan, and the thing that I want to highlight here is that here we have a balance fund that has a Vanguard label on it, so that's a branded fund. And then in addition, we have what you might describe as a white label fund, which actually carries the name of the plan sponsor. So the New York State Deferred Compensation Plan, US Debt Indexed Unitized Account. That's a mouthful. I guess if you can read it, you're financially literate. So this one is a white label branded fund, and we can see that there's several of those on this menu, and they're mixed in with the branded funds as well. So what we're interested in is what people do when they're confronted with a table like this, and whether the fact that they see a white label option, which in this case has the name of their employer beside it as the originator of this particular option, how that changes their behaviour. And we're going to do this via a stated choice environment, an incentivised stated choice environment. Glenn, are you listening?
Yeah.
Yeah, good. Okay. and these are the research questions that we're addressing. So, how do the presence of white label funds and branded funds in retirement plan menus affect portfolio allocations? And is portfolio allocation behaviour driven by perceptions of risk and return of white label fund and branded funds? So there are basically two stages to this stated preference experiment. The first one asks people an allocation question, gives them a problem, how are you going to allocate your retirement plan funds, and the next part elicits their expectations about risk and return using a distribution builder, which I'm going to show you in a minute. So what do we know about this question about labels already, and what can we draw on to help answer this question? Well, first of all, there's a literature in the mutual fund area that shows how fund flows will move to funds that are named with hot styles as opposed to cold style. So whatever's trending, people tend to move their money towards funds that have the names that are trending, regardless of their absolute underlying quality. This gets better or worse depending on your perspective. Other studies show that simple fluency changes the breadth of stock ownership of a company. So Green and Jane find that companies that change their names to one with greater fluency have greater breadth of ownership, and mutual funds with more fluent names have the largest fund flows. So holding other things equal, names matter. And we also see that the fund management companies, so the fund family, their past performance influences fund inflows to the fund with the company's name, regardless of the performance of that particular underlying fund. So just having, if people perceive that Fidelity is doing well, just having Fidelity in front of a fund name will encourage people to invest in that particular fund, regardless of the individual performance of the actual mutual fund that people are investing in. So we see that names matter, both in terms of their familiarity and attractiveness and in terms of their fluency. So our hypothesis is that this changing of labels from a branded label to a white label is probably going to have some effect. The question is, what effect? Okay, so as I said before, we're using stated preference data here. This is the first stage of this study, and we'd like to move on to look at some administrative data. We invited a sample of 1,250 members of the Understanding America panel to participate in this experiment, and we insisted that they be currently employed, that they are or have recently been a participant in an employer-sponsored defined contribution retirement plan, and we picked out people who had already filled in the financial literacy module and information about asset ownership, because we wanted to know this, but we didn't want to ask it again in the survey that we were actually running. And we closed the survey once we reached our target, which was a total of 940 responses. Then once we had selected that sample from the study, we randomly distributed them between 4 different conditions. So this is the structure of these conditions determine the menu that people chose their allocations from as at the first stage of the experiment. In the first condition, we showed people a menu that had investment options comprised of 2 different types of labels. The first were a family labelled high trust brand, and the second were white label. It just said white label. I'll show you how we worded this in a minute. In the second condition, we had a family label against a white label again, but in this instance, it was a low trust brand. In the third condition, we asked people at the beginning of the survey to give us the name or an alias for their employer, and we piped their employer's name in front of an investment option name. So similar to the New York State deferred compensation scheme label that I showed you a minute ago, that's what people saw. They got to choose exactly how that label looked, because we wanted to protect people's identity. We didn't want them to necessarily have to name their employer in the experiment, so they could choose an alias for their employer and against a white label, and then control group simply saw the white label options only. So 4 different conditions. You can see that people were fairly evenly distributed between those. Now you might be wondering how we figured out what high trust and low trust was. And the way that we did this was to conduct a fairly thorough pre-test where we put various actual names of different financial service providers to the panel, and we asked them to give us feedback over a whole range of different indicators, including familiarity, integrity, a variety of different things. And then from that we constructed one high trust brand and one low trust brand that differed only on trust but not on the other things that we surveyed on. So we felt that we had good leverage on trust, but we could be quite sure that we were not picking up other things that we didn't want to measure but that could be related to trust measures. I can't tell you the names that we settled on because for confidentiality reasons, but at the time that people did the experiment, they saw an actual fund family name, that was a high trust brand name, and they saw the low trust brand name, but we can't show those to you. Okay, and they chose a name for their employer. So this rather heavily populated slide is just to show you that we gave people a generic description of the different components of this investment menu. So people got to choose from a standard set of asset class options, a money market fund, US bond funds, large cap US equities, small cap US equities, and then a global fund option. And in each instance, depending on which condition they were in, they saw one of these funds labelled with a high trust brand and a white label, or they saw it labelled with a low trust brand and a white label, or their employer's name white label and a clear white label, or just the white label. In each instance, we described to them that these funds could be managed, the white label funds could be managed by one or more portfolio managers, and that if they saw the name of a professional investment company preceding the fund name, then that fund would be managed by that company. But if they saw white label, this means that the fund has been put together by your employer's retirement plan and given a generic name, and it may include one or more mutual funds which hold the same type of investment. We also told people that these were index funds and that fees were waived. So we set aside the question of differences between these funds in terms of construction, underlying construction, so there's no active management question here, and in terms of the fees. So in terms of the information that we gave to people, again, this is the description of what a white label fund means for the people in the experiment. In terms of the description that we gave people, knowing that these are index funds and that there's no differentiation between them based on fees, standard theory would predict that people should be indifferent between them on the basis of their name. So, so the fact that we're testing for this, we're testing this hypothesis that the labelling matters, but the basic prediction should be from standard theory that the labelling doesn't matter, and that there should be no systematic difference between the amount of funds that people are allocating to the branded one versus the white label one in any particular direction. Okay. So this is the allocation task that each person in the experiment was shown depending on their condition. You can see here that we're asking people to allocate their retirement balance among the investment options that are listed below. We asked people to do that using percentages, so they could put any number between 0 and 100 into the boxes as long as they sum to 100 in total. And we offered an incentive in terms of a bonus to try and make sure that the information that they gave us here was incentive compatible. So the incentive that people were offered was $25 invested at a 5-year return based on the actual allocation that they made in this menu. And we did that with historical returns and simulation in the background.
Did they know how many people were being in the sample?
How many people were in the sample?
Is it 2 out of 1 million or 2 out of 50 million or?
We didn't tell them exactly how many people were in the sample. No. Yeah. That's fair point. So we've got here money market funds, US bonds fund, large cap, small cap, global funds. The order of those was not randomised in the experiment, but the order of the white label and the branded investment option was randomised, so we shouldn't have an order effect in that regard. Everybody needed to put their numbers in and make that add up to 100. And if they were a bit confused about what any of these sorts of labels meant, they were able to go back to the glossary and remind themselves about the underlying assets. Okay, so what happened? This graph I'm just going to show you now, first of all studies the people in the experiment who chose to allocate their retirement account to only one type of fund. So either the branded type or the white label type. So these were all or nothing folk. They chose all branded options or they chose all white label options. In the high trust treatment, we found that the folk who only invested in one thing were significantly more than the folk who only invested in the high trust treatment were significantly more than the folk who invested in the white label treatment. So 38% of participants invested in the high trust treatment only, and 12% of participants invested in the white label treatment only. In the low trust condition, we got the reverse result. 18% of people invested only in the low trust options, and 33% of people invested in the white label option. Remember that they're seeing these two different brandings together on the one menu. Clearly there's a strong preference for the high trust brand over the white label, and a strong preference for the white label over the low trust brand in each of those conditions. When we look at the overall amounts that people allocated to each different type of fund, we basically see the same theme at work. So if in the high trust treatment, we see that 64% of funds were allocated to the high trust brand options and 36% to the white label options, whereas 42% were allocated to the low trust options in the low trust treatment and 58% to the white label treatment. Again, these are indications of the fact that when you're putting these white label options together with the branded options, it's quite evident that what is driving people's views is the comparison between the branded option and the white label option, but which direction the fund flows depends on how people view the branded option. When we look at investors that spread their funds between both the white label and the branded option, we see something slightly different, but basically a continuation of the same theme. Of those who mix their investments between the two different types of possibilities, you can see again still a very strong preference for the high trust brand and a very low preference for the low trust brand relative to the white label option in each of those conditions. So even for the investors who were not all or nothing investors, the effective trust in the brand was still very strong on their opinions. Now, those of you who are familiar with the choice architecture literature, this hasn't really come up in the discussion this afternoon, but it was implicit in some of the results that Alexander was talking about earlier. And that is that it's one of the strongly supported results in the literature is that the shape of these menus drive people's asset allocation. So some of the earlier studies in this area demonstrated that if you add equity funds to a plan menu, people tended to invest a higher proportion of their wealth into those equity funds. It seemed to be driven by the proportion of equity funds on the menu. So it was interesting to us to find out whether changing these labels changed the way that people allocated their funds between different asset classes, or whether it was just influenced by the brand. But what we actually found was that the conditions didn't change the way that people allocated across different asset classes. So if you look across the 4 columns in this table, you're seeing asset allocation across the 4 different treatment groups. And you can see that allocation to equity funds, bond funds and money market funds were overall relatively even between the 4 different conditions. So people tended to allocate about 60% of their wealth to equity funds, about 14% to bond funds and about 27 to 30% to the money market funds, regardless of which set of labels they saw in the condition that we gave them. Okay, so what we're seeing there at that first stage is that we're seeing that in terms of asset allocation, the brand is very strongly influential over the relative allocation that people are prepared to give to a different investment option. So what we wanted then to understand was whether there was some perception of risk and return that was underlying these choices, whether people perceived there to be difference between these funds based purely on the label, and if that was the case, what they were. So what we wanted to do was to try and understand what they thought would happen to their investment after 1 year. So we asked them to give us their subjective distribution of outcomes for each investment after 1 year. And what we did was give them examples of various retirement investments and ask them how much you think each investment would be worth if they invested $100,000 in it after 1 year, and we were going to give them a range of possible future values in a chart to choose from. So I'm not sure, can I just get an indication, how many people have seen the distribution builders before? Oh, okay, a few. So let me just see if I can drive this from here. What I'm going to give you is a high-speed version of the video that we used to train people on how the distribution builder worked. So basically what you've got is a set of balls at the bottom. Each one of those balls indicates a 1% probability. Oh. I've created a monster here. I need to I'll just move through. Okay. So you get the idea, even if you get it very quickly. So in the bottom, there are 100 balls. The idea here is that people use those balls to indicate the likelihood of an outcome. Each of the separate sections in the yellow part of the slide is a bucket. And that bucket corresponds to a range of values that $100,000 could take in 1 year's time. The first bucket here goes from 0 to 74,999. The second bucket from 75,000 to 89,999, 90,000 to 100,000, 100,000 to 110, and 110 to 125. So the task for each individual in the experiment was to assume that they've got $100,000 that they're investing in a money market fund. That might be given a high trust or a low trust label, or it might be given a white label in the experiment. And what you have to do then is move the balls into the buckets according to how likely you thought that particular outcome was for your $100,000 invested in that money market fund. So as you moved, if you put 10 balls in this bucket, that indicated that you thought there was a 10% chance that your $100,000 would be worth between 0 and $75,000 after a year, and then obviously it moves through to the upper bound. Now you'll notice that we set these buckets so that the distances in the intervals are not even. The middle buckets are narrower in value terms than the outer buckets are. And that the central line is a zero return outcome at $100,000. The reason that we didn't make them even intervals is that, as you can well imagine if you understand returns even a little bit, is most of the probability mass should fall into the centre of that distribution builder, and we needed to widen that central bit to get better leverage over what people thought the probabilities of those very likely outcomes were. And to allow these ones on the outside a bit less scope, given how unlikely they are. But basically, after people did the video, they completed this task, what I think was quite well, and people gave us good feedback on the process. So what happened? What did they tell us about what they thought was going to happen?
Since it's a belief elicitation, is this incentivised, or is it quadratic
The
scoring
belief
rule?
elicitation is not incentivised.
And there's no scoring rule in it?
No scoring rule in it.
So I guess if it's not incentivised, you don't have a scoring rule.
No, yeah, no. I'd be interested to know how we could incentivise the distribution builder task.
Oh, there's a huge literature on that. Malthus,
Okay. So in the average expected return, in terms of average expected returns by asset class, you can see that that we get a fair bit of variation in these expected returns. One of the strange results is how high people thought expected returns might be to their money market accounts. Massively optimistic about those, and fairly pessimistic about some of the other components. But the important thing on this graph is not so much the actual size of the bars, but the difference between what people thought expected returns would be to their to the trusted brand account versus the low trust brand. Clearly they thought that there's a really strong underlying difference in returns available to them depending on which of these two styles of branded types they were investing in. And the same thing seems to be true in terms of risk as measured by a probability of loss. So from the distribution builder we can calculate an expected return. We can also calculate how probable people thought getting a less than zero return was to their $100,000. And we see the same pattern repeated here in reverse to returns, where the high trust brand is counted as much less likely to achieve a negative return than the low trust brand based on the distribution builder outcomes. When we compare those scores to actual historical returns, so if we go back and we calculate, take some representative data from these different types of asset class indices and then map them into the experimental returns, you can again see that that the participants in our experiment were very optimistic about money market returns and relatively pessimistic about equity market returns, and also quite pessimistic about the probability of negative returns across most of the asset classes that they were invested in. So whereas they should be expecting no negative returns from a money market account, the average estimate was that a money market account had about a 20 to 30% probability of providing a negative return. The guesses for equity markets were again fairly pessimistic. So we have a fairly strong mismatch between the historical returns distribution and what people were reporting to us through the distribution builder task. But this type of pessimism about equity market returns is typical of a lot of expectations data that people collect. Perhaps I don't have a reference point for the expectation of negative returns, but compared with the historical data, people are quite pessimistic in that regard too. So the second part of this experiment relates to how people respond when they see this choice but labelled with their employer's name rather than with financial service provider's name. So in the beginning of the experiment, we asked people to give us information about how much they trusted their employer, just using a scale. So on a scale from 1 to 7, how much do you trust your employer? We asked that question. We asked a whole lot of other questions later about general trust level and trust in financial service providers. But in terms of this stage of the experiment, what we did was break our sample down into high, medium and low employer trust, where those who trusted their employer highly are those who rated them 6 to 7 on a scale of 1 to 7. The medium group was at 5, and then the low trust group were people who rated their employers 1 to 4. We see here a set of results that reflect what we found when we looked at the branded options, and that is that people are very willing to allocate their retirement savings to a white label option that is branded with their employer's name if they trust their employer. And if they don't trust their employer, there's practically no difference between what people are willing to allocate to an employer-labelled account and what people are willing to allocate to a white label account. So in this space, that's a sort of neutral outcome, whereas if you're a highly trusted employer, you could attract funds into an option that's labelled with your name. These two sets of results are statistically significant. These are indistinguishable. So we also see some evidence for this pattern in terms of people's expectations of returns again. But along the graph here, you can see that the dark blue column are the expectations of returns for investment types that are labelled with the employer's name when the employer is highly trusted, and then the pale blue column is for low trust employers. And although not all of these differences are statistically significant, there are some that are. So you can see here that the difference between the high and low trust expected return is significant. Not much going on here in the bond area. And again, when we go to equities, we start to see more statistical significance. And similar pattern again with expected losses. So again, expected losses are rising in lack of trust and declining in levels of trust. So just to sum up the results here, what we see is that brand trust is a very strong effect in asset allocations, and that participants are significantly more likely to choose to allocate their funds to trusted brands when choosing between otherwise equivalent investment options. So the highly trusted brands are more attractive than the white label options, but the low trusted brands are significantly less attractive than the white label options. Those, if you're an employer and you're thinking about labelling an option with your name, then that will attract funds to you if you're a trusted employer, but it doesn't seem to have any advantage to it if you're not a trusted employer. So it's pretty clear that, that when it comes to menu construction, understanding people's attitudes to these types of different options will be important to understanding the way that funds are likely to be allocated at the time a menu is constructed, and it's pretty clear that this will work out in terms of people's expected returns and risk. So participants in this particular experiment expected higher risk-adjusted returns and lower risk from investment options that had a highly trusted brand name, even though a financially sophisticated investor should have discerned that there is no reason to expect that one would be a higher return.
Is the risk attitude to the subject? Did you do anything on that?
We did ask some information about risk attitudes, and we did econometric work in the paper that conditioned on that, but it wasn't strongly relevant to
like
the outcomes.
Phenometric type things, that sort of risk
we
tolerance
used
surveys?
we asked the Doman question, and we used that as part of the measurement. Yeah, but this is more about comparisons between different outcomes rather than trying to measure people's absolute preference for risk. So comparing attitudes between different options rather than necessarily measuring their perceptions of risk.
Right, thank you very much for the opportunity to discuss the paper. Very, very happy to be here today in the afternoon. White labels, brands, and trust, how mutual fund labels affect retirement portfolios. Let me give you a very brief summary, because I think Susan explained really well all the details that go on in the paper and the experiment. So this is an experimental study examining how plan participants react to white label versus branded options in their portfolio allocation, to what extent branding is important for these things. There's a set of experiments with 3 different randomly assigned treatments where the participants choose between white labels and high trust branded options, white labels and low trust, white labels and employer branded, and then there's the control assignment with only white label options. And other than that, the underlying choices are equivalent in terms of both the risk and return profile objectively and their fees, because fees are also waived. So these are index funds. As Susan said, there's no consideration of active versus passive management here. And there's also no trade-off between high or low fee product from which you could potentially draw additional information that could influence your choice other than through the branding here. And one of the main results, I think, in 2 words, branding matters. It's probably one of the key takeaways here, in the sense that for portfolio allocations, the plan participants are shown to allocate more to branded options relative to the white label ones, and that is to be strongly mediated by the trust in the brand. Positive for high trust brands, not so for low trust brand, as we explained how that was measured. And there's similar, somewhat weaker, but broadly similar results for the employee-branded options relative to the white label ones. And then digging a little bit deeper with the use of these distribution builders, Susan and co-authors were looking at, well, why might that be? I said, does the branding in itself influence risk-return expectations? And it does seem to be the case that, the branding itself appears to be associated with more favorable risk-return expectations on part of the plan participants, and that is probably a key driver behind these differences in allocations that they observe in the experiments. So I thought that was a very nice paper. It was a very interesting read. There's not much in the. I come from a mutual fund background. There's certainly not much in the mutual fund literature on the white labeling versus branding. There's really not much there. Susan was talking about a few papers that look at the fund names, how they're being presented, what kind of words are being in there. But even these papers, they don't talk about white labeling versus branded options, about popular words that are used or not used, and how this drives flows or not. So I think it's very nice, and that's a very topical kind of investigation here. So I like that. I have a few comments. The comments that I have are maybe for some part even my desire to, can you tell me more about this and that? Can you develop in this and that direction? Not necessarily trying to suggest it needs to be done in this study, but it's just like how my thought process was triggered as I was reading the different results. So here's the first one. On the motivation and potentially the external validity of the experiments that have been done. I think the paper, the motivation of the paper could be stronger if there was more, at least suggestive evidence, because there is so little work on the white label versus branded investment products in that literature, that even some suggestive evidence, and I'm coming from a mutual fund, even from the mutual fund names, or perhaps if there was some data from retirement plans, something to beef up a little bit what is there. I'm thinking of flow responses if funds are rebranded from white label to branded options. I'm thinking of potential differences in flow performance sensitivity for white label versus branded funds. Something along those lines that could beef up kind of the external validity of the experimental conclusions from the conclusion that are drawn from the experiments. And I think that in itself would already make the results much more powerful and impactful. So I think that would be nice. The next comment I have is, and that's in the category of, can you dig deeper into the data that you already have rather than going out and potentially collecting more? I was sort of interested in understanding if there is more meaningful heterogeneity among different investors that differ along various observable characteristics. There's table 1, there's a large list of the investor characteristics showing there mostly that they're balanced assignment across the different treatments, which is of course great to have. But I was just curious, okay, what investors are more prone to trust these brands? Is it income, education, all these other kind of things? Risk aversion was a comment that came up during the talk. And so basically, can you say more about than just the broad high-level average differences? Digging a bit more into the heterogeneity that you have in the data, because this random assignment is beautiful. We typically dream about that, right? We don't have it in every context that we have. So that was my second suggestion, to potentially provide a little bit more mileage. Could also help us understand a bit better, where do these differences in the risk-return expectations then come from? What is it related to? So that was my second comment that I had. The third one is a little bit of is coming from a little bit of I don't want to say gap in the study. Is that I would like to see a more clear articulation of what the real trade-offs are that the plan sponsors, the employers potentially face, because in the context of the experiments, as you were saying, on some level, it shouldn't matter. Like the null hypothesis would be that is irrelevant, given that the choices are identical and the fees are all the same. But then, towards the end of the paper, there's some kind of almost normative statements that employers should consider this or should potentially do that. But then the link of these trade-offs to the experiments are not as strong as they maybe could be. Which is on the other hand, I appreciate the discussion of these trade-offs that you have in the paper, right? And you showed those on the first or second slide in the presentation. So maybe making this link between the trade-offs a bit stronger and have those trade-offs somewhat reflected in the experiments or in additional experiments that you may consider running could help us and could potentially help answer a lot of even more interesting questions. For example, by modeling these trade-offs, can we actually get deeper to the what is the value of the brand in terms of like how much additional portfolio flow can you generate, therefore how much is value accrues to one party versus the other, what can we get from there, and or if you want to come in from the other way, how much poor performance can be compensated through better branding and these kind of questions. So looking at the trade-offs a bit better. And the final one, and that is coming maybe also if you try to have some of more normative statements towards the end of the paper. I was kind of wondering to what extent this branding or this selective branding, and this also comes from a behavioral bias, behavioral bend, so to speak, can help address certain portfolio biases that are known to be very prevalent for many investors. For example, could like branding induce plan participants, for example, to diversify better? If that's a pattern that we see that people have to be very under-diversified, thinking about home bias and other kind of biases that are very prominent, to what extent could better branding nudge people to make actually better decisions? Is there anything that your study could say on this? And again, if there was some evidence around that, it would support better the kind of should recommendations that we try to make towards the end of the paper. All right, I don't have too many comments on the internal validity. I thought it was all the execution of the experiments. It sounded pretty well done to me. I thought what you measure is what you measure. I think I didn't have any concern there. So and that's all the comments I had. I really enjoyed reading the paper. I look forward to the next version. I'm happy to discuss more with you after.
Thank you, Susan.
Thanks very much, David. That's really helpful, constructive comments, and I look forward to working on this.
So, before Glenn takes the point, but it seems to me that you can also construct the subjective standard deviations of what people expect.
Yes, we did. Yeah.
So if you look at there, the expected returns and the expected standard deviations.
Yeah. So yes, quite right. And we did construct the implied standard deviations from the interval measures. They're very noisy. We get we've got, you can see that we've got these very discrete buckets. And to compute the expected returns, we take midpoints and figure back out an expected return. The standard deviations were we computed. They didn't give us much systematic information. Yeah, I'm not sure. I think we reported them in the paper, but I can't recall now. It's been a while. I can't remember either. Yeah, but so we did do that. Yeah.
The other thing is that when presented with a list with these funds, there must be some people who are like completely confused by that.
Yeah.
Is there any way you can sort of filter out like the basic noise of people who are just?
Okay. Yeah. So I didn't go into it in a great deal of detail. I guess we did some ex ante filtering in the sense that we sampled people who have at least had some experience of a 401k plan menu. They may not have actually chosen anything from it. They may simply have defaulted into the type of their fund, but they would have at least probably seen one. And we made sure that we were looking at people for whom this decision was relevant in the sense that they were now or previously members of a plan, participants in a plan. We collected fairly extensive information that would relate to measures of financial literacy and financial sophistication. And I didn't go through all the results, but I mean, David highlighted heterogeneity too. But in the background, we have run the usual sorts of econometric models that you would expect to get much more conditional results. But they really don't tell us a lot more than the averages that I presented to you in the graph, which is why I didn't go through them. So the heterogeneous treatment effects are not very strong in the data, and so we have conditioned on those sorts of things, but the story is not sufficiently strong at the moment to warrant a spot in the presentation, if you know what I mean. So I could go through it in detail in the background, and we get little bits and pieces, but I doubt whether they've survived the multiple hypothesis testing process. That's my feeling about it.
So in the first part of the paper on allocations, you told them that these are index funds.
Yes.
I guess in the second part, you didn't tell them they were index funds when you asked about return expectations. And there you saw differences. I'm just wondering.
Hold on, differences in what way?
So if the reason that they're allocating differently in the first piece is because of return expectations, which is what your second piece is about, then that tells you something about that they really misunderstand what an index fund is.
Oh, totally. Yeah. I have no doubt about that. Most people who read this survey would not understand what an index fund is. Absolutely.
I see. So then they really don't view these as being identical in sort of the first piece.
No, clearly not. That's why we see what we see in the distribution board. Yeah.
Wow.
That's what happens when you ask people about financial products. Yeah.
Can you say something about what determines trust? I mean, beyond performance, what kind of services they will provide so that they're trusted?
So to just going back to the pre-testing that we did, I didn't elaborate at all, but there were a series of about 10 very commonly used scales that our marketing colleague Nicole Montgomery has developed and used in the marketing literature, and so sort of a superficial answer to your question is the way that we define trust was defined by those questions that are well tested and researched in the marketing literature. What they mainly relate to integrity and competence of the brand. That's primarily what they're driving at. What they don't relate to here in our study is familiarity. So we control for familiarity and we look for differences after we've controlled for that, if you know what I mean. Yeah. So, but what people are thinking of, I mean, we didn't use the word trust anywhere in the survey. We actually just gave them the brand name. This is a X index fund. This is a Y index fund.
And was there any text to talk a little bit about what it's trying to do and what its returns have been?
Just the table that I showed you earlier that gave them a glossary, which was a generic description of each of the asset classes. So, what a bond fund is in one sentence.
So one of the things we've done in a different context, work for the Fed, is they're very interested in people's hypothetical survey responses about inflation expectations.
Yes.
Some people are in there saying it's always going to be 10% next year, and they've got no clue. We know they've got no clue, but is there some rigorous way of saying that?
Yeah.
So one of the things that we did is we said, well, let's elicit their beliefs about what inflation has been in the last year, the last 2 years, the last 3 years. If they don't have a clue about that, you've got a pretty good prior as a Bayesian that they don't have much of a clue going forward. They're sort of poorly calibrated. So in some sense, what one could do here is elicit beliefs, and of course I'd say incentivize, but I'm putting that aside now. No, I mean, I'm putting that aside of, do they have a clue what these funds have been earning in the past, if they're actual funds? And if they don't have a clue, you've got some basis for reweighting if the validity of their responses. And if they don't have a clue what they've done historically, that's presumably the only basis on which they'll forecast them in the future. And you could, in fact, even show them displays of returns and see if they can actually parse that.
So you're saying that we should investigate further how badly calibrated people are?
Yeah. Well,
which we did do some work doing earlier, just looking at measuring people's deviation from the actual, what would be a reasonable benchmark return for that particular.
I've got no clue. You give me a list of these things, I've got no clue, and I've got the certificates that say that I should.
I absolutely agree with you, Glenn, but for the purposes of the study, how badly calibrated they are is what we're trying to get at, if you know what I mean. Because if people are really badly calibrated, they're more likely to be influenced by things like a label. And then what's underlying the label will be what's driving their decision making rather than any sort of standard. Am I missing something?
Yeah, let me just make the point Mark did in his thesis and I made earlier. If someone's poorly calibrated, what that says is I pay someone to do it. I've got a financial advisor, my wife does it actually.
Or I default.
Yeah, but there's a deeper point here, and that is if I'm aware that I don't know these things, I'm not going to start investing my funds in this. I'm going to scaffold, I'm going to get advice
Yeah.
from somewhere, I'm going to
Okay.
read up on, I'm going to
So,
look
so
it
that's
up.
a really good point, which is how aware are people that they don't know this
Right.
stuff? And I agree. I think that would be something that we should investigate further. Yeah.
So I think my question is a little bit related. If people really believe the expectation of returns that they report, a few years later they should be hugely disappointed, right?
Yeah.
And they should reallocate. And that's not what we see. We see that
Yeah.
like those choices are very sticky,
Yeah.
which would be consistent with those numbers being meaningless in the first place, those expectations.
So you're saying
Like, I
that
mean, they probably have huge standard error or something.
that they should be reallocating if their expectations are so badly off. Yeah, I guess their confidence intervals are also huge.
Yeah.
So you could be getting quite noisy return signals around your biased mean and not really know that you were wrong. Yeah. Olivia.
Just a comment that you made in passing was that you were surprised that so many people thought that money market returns could be negative. And my response was they're showing you their understanding of real returns. And so they're much cleverer than we thought.
Do you think so?
I don't know.
Just be careful. I once made a comment in a conference that said, well, I think my subjects are smarter than me, and Colin Cameron jumped up and said, well, Glenn, in your case, that's true. But I think maybe you might be right. There exists an interpretation such that that's
we're asking people for a 1-year gross return on $100,000, and they're indicating that there's a 30% probability that it could be as low as $75,000 invested in a money market fund. Olivia, that's a very bad negative real return.
I know, but look at Europe. It's negative all over the place.
It is negative, I agree. Real returns, but I'd
Not
be
that
very
negative.
surprised if that's what we're seeing here. But yeah. Okay. All done. Thank you.